What's going on, Dividend Chasers? Dividend Bloodhound here with another investing episode. In this episode, we're going to talk about a key important question, in that is there a tech stock crash coming? Are the tech stocks in a bubble at the moment in the SP 500 and the Nasdaq? Very important question to ask and answer. A lot of people have got an awful lot of money tied up in tech stocks at the moment, in the likes of Apple, Microsoft, Tesla, Amazon and beyond. If this video brings you some value, please hit that like button in the corner over this side, or if you're brand new here, I'm the Dividend Bloodhound, and it'd be great if you hit the subscribe button over in this corner and even tick the notification bell to get notified when I release brand new content such as this. That being said, let's roll the intro, let's get in there and have a look at the answer to this question, an important question at that. Hello again guys, welcome into the video. This is an important question that needs to be answered, and needs to be answered very quickly by analysts and commentators just like myself. Now, the root cause of this is investors betting big on winning companies like Amazon, Apple, Netflix, Tesla, that are doing better than the wider markets that are cooling off at the moment. Like the SP 500, apart from tech stocks, is not coming up as much in value as all the tech stocks that we have seen amid the health crisis that we all know is rife across the world at the moment. These companies that I have mentioned already are flying up at an absolutely exponential rate, trajectories that we have rarely seen in a very long time. This is because it is believed that they are faring better in the health crisis than the other sectors, and this is widely true, to be fair. Industrials, travel industries and retail have all been absolutely hammered, so investors are fleeing these industries and putting their money to better use elsewhere. However, investors seem to be being funneled to the tech industry rather than anywhere else, and it is disproportionately taking a lot of investors' money, and this is creating an uptick in prices that we haven't seen, that doesn't exactly tie into the fundamentals of these companies, even though they are actually doing particularly well and seem to be more robust to the health crisis than other companies. All of this is creating a bandwagon or FOMO culture, where investors are feeling like they are missing out on potential huge gains and are rushing in to buy these companies at no matter what price is on the market at the moment, and that this is caused simply by demand and supply. We all know this as investors, where people are holding the stocks and what they've got, and they're just adding more and more and more. And this FOMO culture, where people are thinking that they're going to miss out, is just almost turning off all the inhibitors, and people are just flying in there and taking on whatever they can. And this is also being slightly fueled by traders and inexperienced investors on Robinhood and Trading2 and the like, that are just jumping in and are trading more the news headlines and investing in the news headlines than they are the actual fundamentals in the company. And this is just the way Robinhood and Trading2 are, is you can literally just invest however much you want. I mean, there's been numerous incidences of people investing their life savings, which is absolutely ridiculous, in companies that they hardly have done any research in, like or even bankrupt companies like Hertz, for example. People were dropping money in there to try and make money in a bankrupt company, or flying money into the likes of Nikola, which really haven't got any fundamentals at the moment either. All of this is creating like an upward trajectory that just looks, the more analysts look at it, just looks unsustainable for the future, which is obviously a bit of a worry for people that are investors that are going to drip into it. It's a bit of a worry for these people. Another argument for the bubble is that if you look at the SP 500 as a whole and then look at the tech sector, the rest of the SP 500 is actually at a loss for the year, whereas if you take tech companies out of it, the SP 500 is at a loss for the year. It's only when you add them back in that the SP 500 turns positive. And that is a big skew and a disproportionate skew, even though I do understand that the value of these companies and how well they are doing, but you have to take into account that the rest of the market is being propped up by just one sector, and that is not a particularly good position to be in. If the plug gets pulled, the plug will get pulled quick, and that will mean that the market will come down in value extremely quickly as well. If you look around the edges of the data, it can be found there are some big shifts going on in the market and a lot of volatility. If you take the Nasdaq, for example, last week it dropped nearly 2.5% in a single day, and that was its biggest drop for well over a month. And that was just like a little squirmy one-off little event, but if repeated, or if repeated worse, could trigger a major sell-off, and that is something that again could trigger this bubble to come crashing down. A simple example I would give of this, albeit it's from the Nasdaq rather than the SP 500, is Tesla. And I know Tesla is looking to get its Q2 results out and potentially end up listed in the SP 500 coming up on the 23rd of July. However, the bullish and bearish puts and calls against this company are disproportionately away from each other at the moment. So Tesla has clearly risen, as we've all seen. It's an absolute monster at the moment. It's risen 300% in the space of a couple of months. I think something like in March, I considered buying it in March at $375 for the share, and I stupidly, now with the benefit of hindsight, I stupidly didn't take the option on it, and I put it back and diversified my money amongst other stocks rather than taking and spending all my money on just the one share. Of course, I slightly regret that now based on where it is. However, it as a market indicator, there is very, very few people at the moment now calling or putting against Tesla, and it's just all the stops have come off basically, and it is just rocketing upwards. But its actual fundamentals haven't really changed, and I get that it's got a really bright future. Trust me, I really love where Tesla is. I want a Tesla car. I love how Elon Musk is running things as a CEO and their future potential. But the way they are flying up is just, the actual fundamentals of the company aren't keeping up with that. And it's the same for many other stock market companies as well, the likes of Apple, Microsoft. They're enormous companies, of course they are, but they're actually now at a higher cost than they were pre-crisis. And I think that suggests that there's a slight bit of a problem there, because they have all still been hit to a degree by this crisis. Not as bad as some other industries, definitely not, but they have still been hit, but the share price isn't really reflectant of that, and I think that is quite important to note. If you are a value investor right now, a lot of value investors have just exited the market or stopped buying completely, because they can see that what they're actually buying, though the fundamentals of these companies are really good, what they're buying is more the hype rather than the actual value of the company. And there is a significant premium to be had with tech companies at the moment. So people are just buying in no matter what the cost almost, and it's just trading away from the actual core fundamentals and money making of the company. Now, me personally, I've literally just opened a Trading 212 Pi account where I'm drip investing £10 a month into the very best tech stocks that I can find. So I'm going to dollar cost average this, so hopefully if there is a bubble coming, I will buy more of that as it comes down, or a crash coming, I will buy more of that as it averages down, and hopefully shouldn't be too affected by it. But if people are rushing in with their life savings and buying at all-time highs, there's a significant chance a lot of people and a lot of investors could lose a significant amount of money if you do that. I think my approach of just investing, seeing how it goes a little bit at a time each month, even if I had the cash, I think I would still do the same, and then drip it in slowly, because of the significant risk that the price could come tumbling down, and tumbling down very quickly as well. This tech bubble is very similar to the dot-com crash in the early 2000s. A lot of analysts are likening it to that. However, what I would say about this is, well, firstly, it took the Nasdaq 15 years to recover from that. 15 years to recover from the 2000 dot-com crisis right through until 2015, and then since then it has picked up. That is an awful long time to take to recover back to where it was. The dot-com crash literally went off a cliff edge where everything just, companies went bust left, right and centre, and people were ripping their money out the stock market exactly the same and finding other places to put it. However, what I will say about that is that back then, IT 20 years ago is a hell of a different place to where we are now. I mean, anything that had .com or technical in the name back then was just invested in, and people blindly invested in it without any regard to how the company was doing, what it actually did. If it had .com in it, it got money. And that is, you can draw a like for like with this one, because again, as I've mentioned, inexperienced investors on Trading 212 and Free Trade and Robinhood are just flooding the money into these companies. However, at the moment, what I would say is that these companies are far more robust these days. So the likes of your Google, your Amazon, your Microsoft, Apple, Tesla, they all have massive revenue streams and are very, very well established now. So as long as you stick to the better companies and the ones that have been around and were potentially around during the last dot-com crisis, you can't go too far wrong. But at the moment, you are experiencing and will pay dearly a heavy cost to get in on these companies, and it is not the best, potentially not the best value for you to buy. If you're trading in and then going to trade out a couple of weeks later because it's gone up in that time, that may be okay. But if you're a value investor looking for dividends or looking for the long term, and there could be a potential crash in the middle of this, that is something to really consider going forward. So for me personally, I will not be changing my strategy at the moment. I know I've just mentioned about a bubble and a potential tech stock crash. However, I don't have a significant amount of monies invested in these companies right now, and I'm literally just drip feeding it in month by month. So if the price goes up a little bit, fine, it'll still, my £10 in each one will buy slightly less. But if it comes down significantly at the same time, my £10 going to buy slightly more. I know long term that I do have faith in all of these companies, but I just am a little bit wary of obviously where the price is now and where it's heading right now, and how pumped up they're being by other investors in the market, obviously. But I don't think it's going to deter me too much. I'm just going to carry on doing as I'm doing, drip feeding in bit by bit. I would just be very wary if you've got a lump sum to invest. Make sure that you would diversify it over multiple companies and don't go all in on one, and be very careful about how much you're investing right now, and consider drip feeding it in at exactly the same time. It might cost you a little bit in terms of short-term gains, but long-term, if the bubble was to burst or there was a crash, you will then be able to de-risk your investment, so to speak. And I'm just being very careful about how much we put into tech stocks right now. That's just my opinion, of course, and obviously everybody's free to do exactly what they want, but I don't want to take as much a risk with my money if I can. I don't want to be completely reckless. I accept risk. Risk is part of investing, and I like to think that I've got a bit more of a risk appetite than the average investor, but sometimes you have to know where to draw the line. In any case, that concludes this video. It's been absolutely fantastic to bring this one to you. I've really enjoyed researching into this and having a look at where the stock market, and in particular the tech stock market, is going, especially the Nasdaq. And I hope you've enjoyed the video as well. If it has brought you some value, please hit that like button over this side, or the subscribe button over that side if you're brand new here and have enjoyed this content, and even tick that notification bell as well to get notified when I release brand new content. That'll be absolutely awesome and a big win, and I will see you hopefully in the very next episode. Bye bye.